Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Jim Falbe, Managing Principal of Saguaro Capital Management. After spending almost 8 years at Vulcan Value Partners, in 2021, Jim left to start Saguaro. The most unique thing about Saguaro's strategy is that it employs an internally built AI system that helps with screening for stocks as well as with investment decision-making. In this in-depth interview, we covered how Jim's experiences at Vulcan have shaped his approach to starting Saguaro, what the term AI actually means to Jim and Saguaro, how the team members use AI now and how they hope to use it in the future, why a SMID-cap strategy was compelling enough to launch with, and why he prefers to invest with companies growing inside of their moats. And without any further ado, here's my conversation with Jim Falbe of Saguaro Capital Management. Jim, in your interview on Capital Allocators, which I highly recommend, you told the founding story of Saguaro. What I'm interested in is what pushed you over the edge to leave a great seat at Vulcan to do something very entrepreneurial.
Well, that's an interesting question and one that I might flip on its head a little bit. I have a lot of people that are like, why did you leave? And I think the more appropriate question might be why I stayed as long as I did. And what I mean by that is most people who are truly world-class who go into the investment management space, whether they want to be an analyst or whatever their long-term goal is, they still have that seed in their mind of one day I want to be a PM. One day I want to be making the risk-based decisions. One day I want to be running my own firm or my own fund. And actually, when I was out interviewing for jobs after I had my MBA at Notre Dame, I was still at Notre Dame, I'd go up to New York on Thursday evenings and would spend Fridays interviewing in New York. And one really well-known, very well-respected, long-only equity manager had me in, super excited to be there. And during the interview process, they asked me, they're like, hey, where do you want to be in 5 or 10 years? And I answered honestly and said, well, I probably want to be in your seat. I'd love to be a PM or I'd love to be running my own firm. And the guy just stopped. He's like, banged on the table. That's the wrong answer. Wrong answer. No, he's like, you want to be an analyst. And he's like, you don't just want to be an analyst. You want to be the world's best analyst. Everything for you is about improving your craft. It's not about being a PM. You want to be the best analyst you can possibly be. And I'm like, blown away. And he's like, interview's over. And then they send me off. And I'm like, oh my gosh, I just totally failed, but walked down the road, had another interview later that day. And thankfully enough, they asked me the exact same question. They're like, hey, where do you want to be in 5 or 10 years? And I was like, I want to be the world's best analyst. I want to get better at my craft and do it, at a level no one else in history has ever done it. And they loved it. They totally ate it up and ended up offering me a job. And I was like, okay, that's really interesting. The way the industry works. But I think the truth is most people who are world-class, they ultimately want to be in the PM or the fund manager seat. And one of the best compliments I ever got from a former partner at Vulcan, who actually joined us at Saguaro, he's like, look, on day one, when you came to Vulcan, I knew you were already headed out the door. And not that I thought you were going to leave quickly, but I just saw that in you. You wanted to build something. And I think there's a lot of people who in the industry, they feel that way. And here we really want to acknowledge that and try to create a system where we can bring in world-class talent, apprentice them, and then one day, hopefully spin them out to do their own thing, knowing that that's their long-term goal. And that's not being a trader or doing something wrong. But I think in my specific circumstance, why did I stay at Vulcan as long as I did? And the answer is because Vulcan is an amazing place, just truly great people that I had the opportunity to work with. I loved our values. I loved the way that we treated our clients. And I was very bought in. CT gave me a lot of authority and decision-making opportunity day one. And then ultimately that grew over time, being able to build out something on the AI side, the data science side, which, finally flowered to the point where, and I think I've shared this before, but, we had this really robust business at Vulcan. It's like, are we really going to risk upsetting that? Are we going to push over this kind of $20 billion apple cart to chase some shiny new object that may or may not add value? And really, that's what ultimately led to the creation of Saguaro. It's saying, hey, we've got this great opportunity, but with the innovator's dilemma, we don't want to pursue it here. We need to pursue it someplace new. So happy to dig into that more. But yeah, I stayed because it was a wonderful place, and ultimately had to leave because we had an opportunity that we thought was rife. We wanted to be modern value investors and try to combine the best in modern technology with this classic investment discipline.
I'll just make one comment about what you said about the analyst versus PM. I think the best analysts want to be PMs, and the PM should want that person to have that authority and autonomy. And because if you don't, I just don't think you're going to be incredible at your craft if you don't want to make decisions at some point. So
I totally agree. I totally agree. But I was just taking the feedback I was given and trying to go with it.
When you think about the strategies that you've launched, maybe talk a little bit about how that experience of maybe getting a little too big in small cap and being too big in specific companies, how has that influenced your sense of the total capacity for the strategies at Saguaro?
Well, our team is unique, and our target, we'd love to be in kind of that $650 million to $1 billion range. We believe that would be enough AUM for us to pursue everything we want to pursue at a world-class level. Underneath that, we still think we're going to be some of the best, but there are some resources that they just require money. And so it's helpful to be at that scale. I think beyond that, there may be some incremental add, but eventually I do think you really run up against performance constraints due to capacity. And so we've tried to align our incentives to encourage us to both get in the sweet spot and then sustain ourselves in the sweet spot for clients over the long run. And so what we do is, one, our management fees actually decline over time as our AUM scales. So if we get to certain levels of AUM, the management fee drops and our revenue will become more dependent upon performance fees, which we really think aligns us for the long term. So we're not incentivized to just get out there and try to manage AUM, grow AUM, and keep AUM, but actually focus on performing for the clients that we have. Two, we have written into our legal documents fairly strict capacity constraints. And so in our SMID-cap, we cut that off at a $20 billion market cap. So really, those mids are in there, but we're saying it's 1.5 billion. And we believe 1.5 billion with a 20 billion top end is very doable. In our large cap strategy, which is 20 billion and above, we've capped that at 5 billion. And I don't know if we'll ever be successful enough or fortunate enough to get there. We believe we can. We believe we've built the infrastructure to manage $10 billion today at the firm. So we think of it in terms of, well, we'd love to build a bridge that can bear twice the load that's ever going to go over it. And so we kind of got this $10 billion infrastructure. We kind of hope to, be that $1 billion fund. We think we could scale to 5 with our constraints, but really not much bigger than that. And then all cap, it's actually a 3C1 fund. So it's limited to 100 seats. So while the strategy could do 3.5, and maybe we have an SMA or something outside, which we'd count towards that 3.5. I think the likelihood of hitting that is lower just because the number of seats is lower. And that's where a lot of our friends and family and internal employees have invested money. And so we've already got a lot of those seats used up internally. So we'll see. But we think we're properly structured for where we want to be and what we want to achieve.
I love that alignment, especially when it comes to the management fees declining as AUM rises. One thing that I found in my experience working a long-only fund is that allocators in the long-only space versus the 2 and 20 space weren't really as comfortable with performance fees and dealing with performance fees. How have you found receptivity? Alignment's great, but how have you found the receptivity within the traditional long-only allocator community to embracing performance fees?
Well, it's multifaceted. So one, we are entrepreneurial. Our structure we're funds. So we're a hedge fund structure, GP, LP structure, master feeder in both our SMID and our large cap product. So we can have side letters. And what we've communicated is we're happy if you want just a straight management fee, we will do that. We don't believe it's the best possible alignment. Obviously, that would be for a client who's larger and has a little more heft because you've got to produce some specific documents for that. We'd also be happy doing an arrangement which was performance only. Our suggestion, though, is somewhere in the middle where, again, we have this declining management fee and performance fee. It's very structured. We have it out there. We've got a couple different buckets. We've got like an anchor share class, which would be the first 5% of AUM, which would get us to break even. Then we have a founder share class, which kind of gets us to that 650 million. That's that next leg to where we have all the resources we want. Then we have standard shares where if someone's still interested in doing business with us, once we're kind of at the level we want to be, the fee is a little bit higher. But again, that's the proper alignment to try to say, hey, listen, we want to get great partners in early who are committed for the long run. And we want to give them something of value for taking that risk on us a little bit earlier. I haven't had as much pushback on the fee structure. I think one, everybody realizes that in the institutional space, it's always a conversation and there's always specifics for each potential client. But we do have an options overlay to our strategy. We are capable of having small amounts of leverage to help us execute that option strategy. So it's a little bit different. We believe, given our concentration, our ultra long-term time horizon, and those other features, that a performance fee does make sense, especially given the structure. And so I think people have been very intrigued by the fee structure. It hasn't been something where people are like, oh no, you should just charge a straight management fee.
Yeah, that's great to hear. So let's dig into the concept of differentiation. And so what I think is different about Saguaro versus just about every other value investor is the use of technology, particularly AI. That acronym, along with the concept of machine learning, gets thrown around a lot. From a practical standpoint, what does integrating AI actually mean to you and to Saguaro?
Well, first and foremost, I think this question probably takes longer than 5 minutes to really answer in a thorough way. And I'll tell anyone who's interested for more. We published a primer last quarter where we took everything we've learned over the last 10 years and we tried to put it together in that primer in a way that is approachable for anyone, even if you don't have experience in data science. So we talk about our journey from absolute zero to where we are today. We talk about all of the resources that we've used. We talk about, here are the basic tools that you need. Here's where we think things are going over the next 10 years. Here's how you can tell the difference between real AI and something that's just marketing spin. So we think it's incredibly useful. I'd encourage you to go check it out. Our website is saguarocm.com. It's there. So if you want more, I think that's there. There's a lot of other resources out there which are mentioned in a primer. But here's what I would say. I think anything you do at a significant level, you kind of need a philosophical underpinning for it. And one of the resources for us on the philosophical level is a guy named Kevin Kelly, who he's a technologist based in Silicon Valley. He's older at this point, but really a techno optimist. He's written several books, done TED Talks. He has a wonderful newsletter that he puts out where he's always trying to stay on the very edge of how technology is benefiting humanity. And he really believes technology is going to change our lives for the better. And so he wrote a book about a decade ago, which I would recommend anyone who hasn't read this book. It's amazing. It's called What Technology Wants. And it's based around this central idea that he calls the technium. And for those who haven't heard of the technium, again, like most people in Silicon Valley, when they have a big idea, they try to make it as big as possible. And for him, he defines the technium as this idea that technology may actually be the seventh kingdom of nature. So you've got the plant kingdom, the animal kingdom, the fungi kingdom, and go on. You've got the technology kingdom. And while he acknowledges that technology is almost it's a part of humanity. So for instance, beavers build dams, ants build nests, wasps build these, wonderful hives, et cetera. Technology is kind of like humanity, like we build these tools, et cetera. But he said that technology has evolved to a point where it's taken on a life of its own. So if you look at technological development over the last 200 years, it's almost like humanity knows what the next step in technology needs to be, or technology is driving its own evolution. And what I mean by that is, it wasn't just Thomas Edison trying to develop the light bulb. There were actually 5 or 6 people trying to develop it at the same time. He just won the race. Or Alexander Graham Bell invented the telephone, but he did it kind of at the same time as other people. And so it's this real interesting thing where you always have multiple teams, multiple places around the globe working on that next step in technology. And so technology is not going to stop its own evolution. I mean, barring, of course, some kind of catastrophe, asteroid slamming into the planet or World War III or something like that, but it's just going to keep pushing. And number 2 is this idea that, and everyone is aware of this, technology is on an exponential growth curve. So it's not linear. And the mistake that a lot of humans make is we think, okay, well, I've been alive for 30 years. Here's how technology has developed since I was born until today. And so I think technology is going to increase the same amount from the time I'm 30 till I'm 60. And that's incorrect. Technology is exponential. And so the growth that you're going to get in the second half of your life, the change that you're going to experience is much, much bigger than the change you experienced when you were young. And this is why a lot of people who are, elderly, they come back and they say, man, technology, I just can't keep up with it. And the reason is the rate of change is so much higher than it was in their formative years. And so for us, when we put those two things together, we say, listen, technology is the primary thing that makes humanity different today from what it was 50 or 100 years ago. And frankly, we think that this acceleration in technology is going to continue. Truthfully, we believe that the change over the next 10 years in the finance industry specifically is going to be greater than the 100 years previous to it. And so for us, we want to be on that curve. I mean, we think of it almost like a wave that we're trying to catch if we're out surfing, and we want to catch the wave. We do not want to be drowned by the wave. We want to ride it. And so that means we have got to be on the forefront. We need to be investigating it. We need to be building it. We need to say, hey, how can we use this for our process? So specifically to answer your question, the way we think AI is useful is not buying some product off the shelf. So everyone's going to have ChatGPT. Everyone's going to have Microsoft Copilot. A few years ago, everybody had Google search, and anything that's AI at scale, everyone's going to have. And so the question is, what makes you unique? Right? One investment firm having Excel does not make them better than some other firm that has Excel. Everybody has the same tool. But if your firm is capable of generating excess returns, if your investment process and your investment philosophy leads to true alpha, then AI or data science can help you accelerate that. It can help you amplify that. If as a firm, you're not capable of generating excess return or alpha, I'm sorry, AI isn't going to make you any better at what you do because you're not good at it. It's going to amplify what you already have. And I think where firms really need to look is, number one, what is our secret sauce? What is our Promethean fire that enabled us to be successful, to raise 5, 10, 20 billion dollars? And can we categorize it? Can we say exactly, this is our process, this is our philosophy? Because if you can, then it's about gathering your own data, collecting it, and ultimately you can use these models to amplify what you're doing. So at Vulcan, we were about finding quality businesses. At Saguaro, we're about finding even higher quality businesses. And in both cases, we've been able to use machine learning. We've been able to use data science to categorize our process step by step, identify what it is that we're looking for, and then set the machine free on the entire globe of companies, right? I would say that our human research team today is still much better than any AI model at picking a high quality business. But there is no analyst on earth, including Warren Buffett, who can look at more companies in a given year than the machine can, because the machine can look at all 60,000 in about 2 hours. And at the end of that 2 hours, it's like, here are the ones that I think are the very best. Here are the ones that aren't. And I'm not just looking at it from a quantitative standpoint. I'm actually reading all of the documents, summarizing them, going through them, and looking for competitive advantages, et cetera. And so for us, it's been this huge accelerator in trying to find those next high quality businesses, especially in the SMID-cap space, where it's like, okay, we not as aware. And I mean, we can talk about that a little bit later. But I think for any firm out there, if your secret sauce is you're looking for culture, or you're good at looking for turnarounds, or you're looking for roll-ups, I think the same technology could be applied to your process if you have data from a long enough period of time and you're willing to change the way you operate to integrate these models. And so if you really want to add alpha or excess return using AI or data science, it's about building something proprietary based on top of what you already do. And if you do generate excess returns, guess what? AI can help you do it at an even higher level. If you don't, it's not going to be a savior. It's actually going to push you further behind other people who are good at what they do. So, we're actually talking with, helping several people, try to understand what they could do to make themselves better, and think that maybe partnering with some other people might be a way we can accelerate what we're doing too. So, very excited about that. And, I think AI, it makes us better at our secret sauce. And we're also looking for ways that it can make us better kind of around the edges. I have no idea what's going on there. That was weird. There's also ways we think it can make us better kind of around the edges as far as executing our process. But yeah, that's a long answer. Sorry.
No, wonderful. Thank you for sharing all that, and the background, the Kevin Kelly background is really interesting. Is the feedback mechanism of determining whether it's adding value and whether it's enhancing your secret sauce, is it the same kind of, I don't know, 3 to 5 years to determine what, whether or not you're any good at investing, right? Is it any different because of the AI? Would you, like, if someone was sitting in the allocator seat and saying, okay, these guys have an interesting approach, they've got a good value philosophy, how long should we give it to figure out whether it's really working? Is Is it any different than in a traditional investing situation where they're not using technology?
I think as far as trying to gauge our process, because again, like I said, AI is an amplifier. It's not necessarily something that's going to be a differentiator. So if you want to know our process, does it add alpha? Does it add excess return? I think you're still going to have to evaluate kind of that 3 to 5 year time horizon. As far as is the AI working, that's something which you can simply see. So anyone who's come in and said, okay, well, we want to see the AI, we're like, all right, well, tell us what you're looking for. And then we have the AI produce what they're looking for. And frankly, people go from skeptical to, oh, wow, this is amazing. How can I use this for my process? I had several allocators say, hey, could we use this for manager selection? And the answer usually is, well, we don't have as standardized of data. This is much better in the public markets because everything is standardized versus private. You could do it in the private markets. You could probably do it in the manager selection area, but it would take a very long time, creating the database, so to speak. So for us, when we did this at Vulcan, the first 3 years were really about standardizing the data, getting it ready. And the same thing here. I mean, while we're able to do it faster today, because most of the data providers like CapIQ or FactSet, et cetera, all have APIs and everything is a lot more standardized. You still have to clean it. It takes time. But, if you're operating in a private space where you're going to have to web scrape all the data, that's going to take a long time to do. And then standardizing it is going to be a huge pain. It would be possible, but it'd be very expensive. So, but again, anybody who sees the output, you can tell quality. So our research team knows that it's working because we know what we're looking for. And when the machine suggests, 50 companies we've never heard of before, that when we look at them closely possess all of the attributes that we want, that is incredibly valuable for us. And so, our guys describe it like Christmas when a new list comes out. They're like, oh my gosh, I want to see that one. I want to see that one. And they're just these really interesting names. So.
And you've talked about investor education. You put out that primer. You can show someone the output, which I guess is pretty compelling. What else about the investor education process has been part of part of your approach when people are sitting next to you and being like, well, why is this different? Why do we want to do this? Why is this better than what you had, than just a bunch of analysts doing the same thing?
I think the conversation is very different today versus November of last year. So prior to ChatGPT kind of hitting the mainstream, there were a select few who were very interested in what we were doing because they kind of understood the models. And, some people have wanted to dive into the code. Some people have just wanted to see the inputs or the outputs. But, since ChatGPT came out, everyone's like, oh my gosh, this is the future. It has to be part of what investment firms are going to do. And I mean, I'm talking everybody from very small allocators up to Goldman Sachs. We've had conversations with just saying, hey, how are you using it? And how is it going to impact long-term investing? Because you've got that whole crew that have been doing trading. And, obviously anything that's high frequency, very, very rapid, et cetera, that's prime for machine learning models. But how do you do it in kind of this long-term bottoms up fundamental way? And that's a question people are trying to answer right now. But no, the education process used to be much more, if people were interested, we'd talk about it. If not, we'd really just focus on kind of that classic investment discipline that we have. Whereas today it is, people have gotten up to speed. I think now people want to ask us, well, what kind of models do you use? And they understand the difference between transformers and what came before, and they would know about XGBoost and random forest, et cetera. Whereas again, 2 years ago, that was not part of the conversation. It was like, okay, you talked to IBM about Watson. How did that go? And really, if you answer that next question, they kind of gloss over because they didn't have the background. But most of the allocators that we talk to are very intelligent. I mean, these are some of the most astute institutions in the world, and they've really gotten up to speed on AI over the last 2 years. So it's wonderful to have those conversations at this point because we can clearly show the value we have created, what we've done, and they understand why that's valuable and how it differentiates us from people who are just getting started today versus we've been doing it for a decade. And, just understanding how the database works, it takes a while to kind of get up that learning curve if you're starting from zero.
And I'm interested in your perception of the proper team size. Does having the technology working in the background reduce the number of people you ultimately need to run whatever you said, 10 billion, let's say you get there, or even half of that? Is that the same team size you would need absent the technology, or is it fewer?
Well, unfortunately, data scientists are not cheap. And so data scientists or research analysts, I would say, are almost interchangeable on cost structure. So I think ultimately there's going to be some scale advantages. And we do believe that while we may not be replacing people or headcount, ultimately productivity for the firm as a whole will be exponentially higher. So it's 2 + 2 = 5, or 2 + 2 hopefully equals more like 10, as opposed to 4. So our research team, we think, can be a little bit more compact. And we believe that the right size in a room debating ideas is probably about 5. So if it's just one person, that may be ideal, but at the same time, it's really tough to kind of get that feedback on, is this correct? Is it not correct? You feel like with 3, which is where we're at today, sometimes the discussion isn't as robust as we want it to be. So we think adding 2 more is probably good. We think an odd number is definitely a have to have, versus we don't want ties where it's just like, okay, you're kind of banging your heads against each other. But I can also say with confidence, when I've been in rooms with many more people than 5, oftentimes people just talk because they feel like they need to talk, to be seen, to be noticed, and the discussion doesn't necessarily improve. It doesn't go in good places. So we think, technology is wonderful because we believe we can have the productivity of a 10, 12 person team, but we can have the decision-making capacity of really that 5, which we kind of think is an ideal number. And so I would put our productivity today with just 3 people up against a lot of truly great firms. I think the level we're able to get out, the pace with which we're able to move through and find these truly wonderful businesses is incredible. We're all very proud of what we've been able to do just in the first kind of year and a half of research productivity, and believe we can continue to scale that from here. So technology definitely helps. Unfortunately, on the cost side, not as much.
Mm. And so there's one aspect of the AI which is covering a lot of ground and unearthing ideas that may not have fallen into your lap previously. And now I'm interested in the evolution of it and how decision making can evolve as the data set gets better, as the machine learning gets more sophisticated. So how do you think the AI will impact that, whether it's a three or 5 member team? How do you think it'll impact decision making in a way that you're not necessarily utilizing it now, if at all, I guess?
Well, I think one of the things we've really begun to investigate more recently is the long tail of information on every single company. So human analysts just don't have the capacity. If you have a business that's called 20, 30 years old, no human analyst can go back through and look at every document that's ever been produced by that company. Machines can. And so if we have red flags, yellow flags, green flags, things that we know we're looking for either to the positive or to the negative, the machine can suss those out and say, hey, listen, while you don't have the time to review every single document, here are a couple things you need to know about. 2, it can create histories or summaries of these companies over the very long run. So most analysts will tell you, if there is a book that's been written about a firm and you can really trace its evolution over time and understand the story, it really helps you understand why they're positioned the way that they are today. And by looking at their past development, it gives you maybe a better insight. I mean, you're still going to be wrong trying to predict the future, but it gives you better insight about where they might be able to go going forward. And so for us, we can do that. Right now, we can take every document the company's ever produced, and we can, number one, anytime, anything. So right now, anything that a company releases, we get a summarization of that 1 time per day. So anything on one of our kind of watch lists, which we call the SCM 100 list, anytime there's a conference presentation, anytime they put out an earnings report, anything, we're going to get a summarization on that exactly the way that we would want it. So here's the general numbers. Here's what's happening to their competitive advantages. Are they getting stronger or weaker? Here's, the things we should be aware of, that all that stuff. And it comes in, it's really incredibly helpful. We're watching every name on our list every day to understand where it is from a valuation perspective. All that stuff is automated. And I think if you're not doing that, that's crazy to me. But it's the fact that we're now able to do kind of these deep dives on businesses where we can say, we can go back to the beginning of time until now. And while the human hasn't read every single document, you can be darn certain that our institution has, because the AI has gone through, it summarized those documents, it's looking, and we're crafting those stories. So that's something we're working on at present. And I think we'll probably have something active there pretty quickly. I think, with the next iteration of Claude, the next iteration of ChatGPT, the token count is going to go up significantly. And that just means the size of document that you can feed into it will get bigger. And as that happens, it will be easier and easier to kind of produce these summaries. But it's something you need to know how to do and craft. And we're very excited about using that to help improve our decision-making, because we know we've at least explored all of the information. We may not have seen it with our own eyes, but it's not like it was completely left untouched. So that's helpful. I think 2, doing a pre-mortem, post-mortem, very helpful. Pre-mortem, just idea generation. Post-mortem, we record all of our research meetings. And obviously, when we go back and we want to understand why we got something right or why we got something wrong, we have that raw data. But the other nice thing is, again, the machine can summarize, the machine can tell us who had what viewpoint, when, the date, kind of what their general arguments were, et cetera. And so it really helps us summarize all of this past data we've created internally very quickly. So just having that underlying data is what gives the edge. It's not necessarily the tools, but I can't tell you how many firms I've talked to and they don't capture their own data, which I really don't understand. If you want to improve at what you do, you've got to observe what you do so you understand where you're weak, where you're strong, and you can improve that decision making. So for us, we believe that having that real feedback where it's objective. Because I mean, I'll tell you, there's been a couple of times where we've disagreed on something and, something maybe didn't go exactly right. And one person will say, well, I was against that idea. I said we should never do that. And we're like, okay, well, let's go back and watch the tape. And we go back and we watch the tape. And it's like, that person's like, this is the greatest idea we've ever had. We need to go big on it. And they're like, okay. Well, I was wrong then and I'm right now. But at least they can't hide what they actually said. And so, very, very thankful for technology.
Yeah, I love the recording decisions. It's one of the things that my prior firm that was my favorite in terms of that, that hindsight bias not creeping into the future decision making. So let's dig in a little bit to the strategies. So you decided to have 3 strategies when you launched, as opposed to focusing on one and getting it right, kind of immediately out of the gate. What was the rationale there for starting with 3?
Well, one, we really view it as one strategy, one philosophy, one process, one team. So it's not that differentiated. I mean, it's 20 billion and below is in SMID-cap, 20 billion and above is large cap, and then all cap is the best of both worlds. But it's really just not that differentiated. So even if we hadn't launched our large cap strategy, we're still looking at all the same large cap names for all cap. And, even if we hadn't launched SMID cap, we're still looking at all the large caps and all the SMID caps for all cap. So we don't really view it as a huge extra lift. And our portfolios are ultra low turnover. So we're tracking well below 20% at this point. We don't do a lot besides writing options in the actual portfolios. I mean, we're trying to find the best businesses on earth. We then wait for that once in a decade type opportunity when they really get discounted to add them. And then when we want to hold them as long as possible and allow them to compound and do their thing. And so it really gives us the time and the flexibility to get out there and look for those incremental ideas, to learn, to get up to speed on industries and to follow development changes, et cetera. So, we didn't really view it as hugely negative from a workload perspective. I think when I was starting out, I really wanted to I'm just all cap. That's all I wanted to do. One fund, be focused. But, as we're going to market, you have your ideal of what you would do if you're managing money by yourself in a room. And then you also have, what is the market asking for? And Vulcan's small cap strategy had been closed for more than 5 years at that point. And there were a lot of people saying, hey, listen, you're the first breakaway from Vulcan. We would love to have access to SMID cap, small cap type manager. And so the decision was, well, we have a lot of people who seem very interested today. And this is fall of 21. And so we're like, okay, well, we'll go ahead and we'll probably do that. And then fast forward to, 22, and the world has changed. Interest rates are going up. Everyone's allocating to fixed income. And, unfortunately, there were some other headwinds as well. But, public equities are not super popular in 22. They weren't super popular at the beginning part of this year. I think there's some small green shoots we've seen in Q4 of this year. So hopefully that will continue. But the other thing was we always thought maybe we'll do a large cap strategy one day if SMID cap and all cap are over full. If people want to continue to allocate to us, we could have it. And then in Q2 of 22, again, it was just this massacre of truly high quality businesses that were large. We thought this was almost a generational type thing. We need huge discounts in the big ones like Amazon or Google or Microsoft. And I mean, if you look at them, they're all up like 60, 70% this year. I mean, that's an incredible run. We went ahead and rolled forward large cap just because we said, if we're ever going to start a track record, we believe for our strategy, now is the time to do it.
And so your strategies are quite concentrated in the 7 to 15 stock range. As the AI gets better and you have more data and you can establish even more conviction, would you expect to become more concentrated over time because of that conviction, or not necessarily?
I think we're going to get more concentrated over time, but not because we have higher conviction in any one idea. It's just as our SCM 100 lists get fully built out. So at this point, they don't quite have 100 names on them. But once they do, we believe we'll have more opportunities at any given time where a company is kind of trading at or below our low end of estimated value. So one of the requirements for us to buy something is not just that it's a super high quality business. It also has to be at that kind of generational type discount. And so we don't think in terms of point estimates of value. We like to think in terms of valuation ranges. And we really want to only purchase something when it gets to the low end of that range. So for example, I don't know exactly what Amazon is worth, but I'm very confident Amazon is worth more than X and it's worth less than Y. And so if I can wait to buy Amazon when it's kind of below X or at X, we feel very comfortable that over the long run, it's going to do incredibly well. And so the more names we've identified that are high enough quality for our process, the more opportunity we likely have to make those purchases when they're selling at a discount. If you have 100 and, typically these things only get discounted once every 10 years, then hopefully, 5 or 10 of those names might be discounted at any given time. Hopefully a lot of them are in our portfolio, but there's an incremental 1 or 2 every year that we could be investing in if we have new flows or we have the opportunity to kind of reallocate in the portfolios. So I think as that gets bigger, we'll get a little more concentrated because we can take bigger positions in those names that are discounted. Today, if we have inflows, we still want to allocate. And so if something is kind of below where we think the middle is, but it's not quite at the low end, we take a smaller weight. So that's more of a 5% weight versus 10% weight is really our core, which says it's a top 100 business. We followed it for more than a year and it's at or below the low end of our valuation range. And so I can't just magically make names discounted. I mean, I guess I could if I lower my discount rates or up my growth rates, but that would not be doing this the right way. So
it's funny you mentioned Amazon. I have a question about that. So one of the concepts you've highlighted in the past is finding companies whose growth is inside the moat, meaning that they don't have to rely on growth in a vertical or area where they don't have a strong competitive position. But you've invested in Amazon, right? Which AWS was in a tangential business, but not, selling books. So I'm interested in how you square those two things about focusing on businesses that kind of have one core strategy, one core product that they can grow versus, trying to invest in companies that have the capacity to have a second act.
Well, first and foremost, I want to say Amazon prior to AWS would not have qualified for us because they didn't generate cash. They were this wonderful big business like, we're going to be cash flow positive one day, but they had never proven that. And so we would have stayed away. And, AWS really was the thing that flipped the switch, made them a cash cow and ultimately something that we would look at or potentially invest in. And I think this is a great question because the prototypical company we talk about to describe this concept of growth inside the moat is Visa or MasterCard, where they've grown for decades just by riding on the payment, super cycle. And that should continue for another 30, 40 years as people shift away from cash to more electronic payments. Plus they get inflation, plus they have a little pricing power. It's amazing businesses, right? But there are other companies that actually are a collection of multiple of those. So, I mean, you can think of like S&P Global, which may be my favorite business in the world. They have their ratings business on the bond side, which, again, it's a government granted monopoly, but there's only 2 of them. S&P and Moody's, you've got Fitch kind of way off in third place, but they've got this incredible ratings business where, again, they also get inflation. They also get a little bit of pricing power. And as the complexity of bonds gets higher and higher as some of these other credit products, they get to charge more. It's just such a great little business, but they also have an indices business. They also have Platts, which is the pricing of global commodities. So if you're trying to land a plane in Japan, you access Platts to know what the cost of the jet fuel should be. And it's a trusted third party, wonderful business. They bought IHS Markit, which is one of the, testing inspection certification companies, also a top one. I mean, just some incredible collection. And so it doesn't have to be one product where the growth is inside the moat, but for any business line that we're really going to ascribe value to, we want to see that growth is inside the moat, right? I mean, it's the same thing with Microsoft. They have Office and LinkedIn and Windows and their ERP and CRM stuff. They've got SQL Server. They've even got their gaming platform, which is now so much better with Blizzard and Activision. And so these are tremendous companies where we would value each one of those segments as having the same type of, growth inside the moat that we're really looking for. I think the big question is just when a company is looking for new growth and it starts something new where it isn't at that level yet. So, you mentioned AWS and let's go back to Amazon. Let's assume that at the beginning, the core business had qualified. We probably would not have ascribed a lot of value to AWS. I mean, another company in our portfolio is Teradyne, where they They produce, the testing equipment that goes at the end of the fabrication of chips. So they can do wafer testing, but they can also do like the complete, once the packaging is done, you can check to make sure that these chips are functioning the way they're supposed to once they've been fully manufactured. And that's a phenomenal business. Well, they've also got this other business, I'm not going to go into it right now, but they have another business that's totally unrelated that at this point does not have those competitive advantages. And so while that business is there, it's part of the value. We don't ascribe the same level of growth to it. We don't ascribe the same level of value to it that we would the testing business, which is kind of the core. Amazon is amazing. Obviously the retail business today is pretty good, not because the retail business is solid, but in addition to AWS, they're now really this third party firm where it's third party seller services, right? And you've got to advertise to drive people to your, to your specific page at Amazon or your specific product that you're trying to sell. And they do fulfillment as a service. So just out of curiosity though, Ben, I mean, do you know out of all the units that Amazon sells, what percentage do you think are Amazon selling products that Amazon has? And what percentage do you think are third parties selling on Amazon?
Let me say 30-70, with 70 being a third party 3PL stuff.
It's actually the other way. So it's 40% of volume is Amazon product and 60% is third-party sellers on the site. And every quarter that ratio keeps ticking up. So I don't know where it'll kind of finally cut off, but the third-party sellers are taking more and more. And it's really incredible because Amazon, people a couple of years ago, they talked about Amazon as retail and AWS. And recently in the last, call it 3-4 years, maybe people are saying, okay, well, they're retail, AWS, and advertising because all these people are, paying for advertising. But they've built an entirely new business, which people still aren't talking about the way they should, which is logistics and fulfillment as a service. So what people don't realize is this past quarter, Amazon actually delivered more packages, not letters, but packages than UPS and FedEx combined. Not bigger than one of them, combined. So Amazon's logistics business is on par with, if not bigger than either UPS or FedEx. And people don't realize that. And this third-party seller services thing is huge. It's really fulfillment as a service. So what I do is I find a product I want to sell. I figure out how I want to position myself in the market. And if I can get the manufacturer to send that product to Amazon, they do everything else. They will distribute it, logistics. They will take the returns. They will handle payment, all of it. And so it's really that they're just saying, hey, listen, we've built this incredible platform and now we can empower anybody to use it. And obviously we can charge for it on the advertising side, but also on the fulfillment side. And so, again, wonderful business. We're ascribing value to parts of it and we're ascribing value growth to parts of it, but maybe not to others. So sorry, long-winded answer for a very simple question, but I love talking about growth inside the moat, and all of our businesses, we believe, really have that. And that's what sets them maybe not fully apart, but it's a big part of our strategy.
And when I think about the technology that you're using and the fact that the machine is kind of out there looking for things, including changes in industries, and I think you'd have an advantage when it comes to both inflection points, both positive and negative at companies. So I'm just trying to get a sense, like when the machine's out there looking for stuff and potentially could flag a positive or negative inflection point, what is the output of that, right? You say you get like press releases and stuff like that, but what is something that was more macro than that? Like we've seen an inflection point in a business that looks like really positive and could change the valuation trajectory, like looking at AWS 15 years ago. What kind of notifications, what is it actually doing to give you a sense of what's happening?
Yeah. So I want to be very clear. That's still a capability we're building. It's not something that we're using on a day in, day out.
Sure.
But we have kind of the roadmap to get there, and we believe it's very possible. But I also want to be clear that what the machine is going to be very good at is identifying patterns of things that have happened before. So if you're talking about a cyclical industry and it looks like, okay, all of the cyclical indicators are pointing a certain way, I think that's going to happen. But what we're really hopeful for is not that the machine is going to tell us, hey, there's something new, there's a disruption coming, you need to be prepared. What it's going to do is flag that disruption is happening in other smaller, weaker companies in an industry. Because again, we focus on the highest quality businesses. Disruption tends to impact the weaker players first, as opposed to the stronger ones, just because they feel it. And those are not companies that we're necessarily covering on a day in, day out basis. And while we might not, expect the machine to be able to tell us, hey, this is what's happening and here's where it's going to go, it can tell us, hey, there's something new that I haven't seen before and I'm seeing it more than once, or I'm seeing it multiple times. You need to look at it. And so, again, if we can just get ahead of something by a few weeks as long-term investors, and that happens once every 2-3 years, it could potentially create a lot of excess return or alpha in the portfolio. And so that's the hope there. But again, it still has to be proved out.
And since have an affinity for SMID cap myself, having managed money in that space, I'm clearly a fan of that strategy. What was so interesting to you? I mean, you said that like Vulcan had that history of small and SMID, but why launch with that versus why was that core to the maybe the strategies that you launched with, as opposed to maybe like just all cap or just large cap?
Well, one is what I already mentioned, which is I think there was a level of demand and interest for SMID cap. And so there's two parts to this. One, you want to be the best investor you possibly can, but it is also a business, and we have to deliver something to the world that the world wants. I'm a big fan of Peter Drucker, and he says, hey, profits are the indication of, are you adding value to your fellow man? It's not just, oh, you're making money. It's like, if you're not generating a profit, then maybe what you're doing isn't that valuable. And so we do aim to hopefully generate a profit so that we're adding value to the world. People want SMID cap. Two, I really believe that the best way to win at something is to kind of have an unfair advantage. The question we often ask is, well, how do you beat LeBron James? And the answer is, you don't play him at basketball, right? You want to do something different. And kind of keeping the basketball analogy going, SMID caps in a way, or micro caps, especially if you do that, is if you could take an NBA player and you put them in a high school junior varsity game, they're going to do incredibly well. And the nice thing about the investing world, it's about financial return, and no one really cares where you compete. What they care about is the return that you're earning on capital. And so if there are inefficient places in the market where you can take world-class skills and apply them against less or weaker competition, that's a phenomenal place to play. And so I think a small cap strategy, the reason why great small cap managers tend to fill up really quick and then they're closed and then they don't open, is because you can create alpha in that space. And so I think SMID cap is wonderful for that. And then three, as I think I mentioned, but when the AI is out there looking for truly great businesses we've never heard of before, that's more likely in the SMID cap space, right? If there's some other Amazon out there that our team has never evaluated or never heard of, shame on us. Like, we should be aware of most of the really true mega cap, high quality businesses. And so in the large cap space, while I would expect there to be a few that trickle in specifically from other geographies or perhaps companies that we had a bias against, I think it's going to be most beneficial in this mid-cap space. And that's what we've seen thus far. It's where it's most exciting to kind of talk with allocators about, the things it's uncovering, et cetera. So that's really kind of the three big impetuses, which is one, it's the business opportunity. Two, we think it's more efficient. And then three, we believe our AI systems can add the most value in mid-cap. And so all cap, same thing, but large cap, while it does add value, it's not as much as in that smaller space.
And if you built a database of the 100 best companies, logically you could invert that and reverse hit the reverse button and find a list of the 100 worst companies, or 100 companies that are being disrupted, or 100 companies that are in negative inflection points. I don't know if this is on the roadmap at all, but could the AI be used to be a good short as well? Tell me a little bit about how you thought about that.
100%. So we've tested it, at our prior firm, we've tested it here, and the answer is 100% yes. It really can do that. Now, I think it's harder to do a back test on shorts because it's really hard to model your actual costs of shorting positions. There's a lot of flexibility there, but we think it's incredibly powerful because the nice thing about AI is it can run ultra diversified portfolios. It can run them at very low cost, et cetera. So I think, without question, if we are successful and we kind of get to where we need to be at one point, we will offer a long short offering on our products where the longs that we have will be the longs. And then we'll have kind of an AI led, human reviewed short book, which again, it's going to be a much broader book than we'd be able to manage on our own doing that. And so very much it's in the roadmap just because it's something that a lot of people ask about, and it'd be very possible. I want to be clear, we don't think the AI technology is ready just yet. I'm not sure if it's for 3 months out or 3 years out, but the hard part would be you still got to have human review because of hallucinations. So no matter what we do, once in a while, we'll have a name comes through that just shouldn't be there. Like there's no data at all. And for some reason, the machine puts it through. And so we've got to go back and figure out what the problem was and readjust for that. And, anyone who's used ChatGPT or whatever understands that once in a while, you just get something really weird in the result. And so, once that gets to a low enough amount, then I think maybe you could do this, but it's not ready. And so there's a lot of people out there like, we got an AI fund and we're running it. And I'm like, man, we've been doing this for 10 years. And I can tell you the technology today, it is not ready to do it without oversight. So if you're doing it in partnership, which we think is the best thing to do for the next 10, 15 years, that's great. But if you're just setting it and forgetting it, watch out. This is not high frequency trading where you're getting instant feedback and can refine those models. This is, you could have a problem and you don't know you have a problem for 3 to 5 years. And so, we're a little hesitant to launch that just yet, but it's something we're investigating. It's definitely on the roadmap.
Talked about technology a lot. I want to make sure we address culture and people in this podcast because this is an investment firm and it's very people driven. So you tell this amazing story of how you connected with Paul Black of WCM, a firm that has raised billions of dollars in assets in recent years, and now Paul's on your board. What does he bring to the table, and what have you learned from Paul about his experiences at WCM?
Paul's amazing, and I'm so thankful for him. I'm so thankful for our whole board. What I would say is a lot of people look at the success that WCM has had, and what they don't realize is the history of that firm. So that company has been around for, decades. I met Paul back in the early 90s as a teenager, which I think I shared in the story you're referencing. But, WCM from that point when I met them had kind of a first successful run where I think they got to 1 to 2 billion in AUM. I could be off. They may have been a little higher than that, but then they hit a real rough patch where they collapsed from that point to, I think it was in the $400 to $600 million range. It might've been lower. I didn't look at their numbers prior to this, so I don't know the actual ones, but they were having hard conversations about, do we need to shut funds down? Do we need to let people go? And they had to go through this terribly difficult refining process before they kind of found what their secret sauce was, which was really both, one, identifying great cultures, and two, their perfect niche was kind of international growth. And when they found that, they've kind of grown into the WCM that we know and love and respect today. But the wonderful thing about talking with Paul, the thing he's helped me with is realizing, one, it's not the good times that produce the world-class culture, the thing that you want to be a part of. It's the hard times. And it's the way you respond to that. I mean, he tells stories about how in the first 3 years when he was there, he just drove up and down the coast of California, meeting with every RIA he could possibly find, trying to get that first $100 million in the door. And, it was a 3-year process for him to get that first allocation, which what a level of commitment. But then to go through that, build a business and have it almost fail, and then you're able to run it back and kind of build it again. That's truly incredible. And so he's helped us. We have had a little bit of turnover. We're a startup this year and some difficult things, but he's been really helpful to say, hey, listen, let's stay focused on the vision and let's stay focused on the long term. You're not building something for next quarter. You're not building something for next year. You're building something for the next 2 to 3 decades. This is a 20 or 30 year cycle. And while you're feeling that volatility right now, if we stay focused on the long run and you zoom back out, you realize that the near-term volatility, it's going to be inconsequential. It just doesn't matter. What matters is where you're going in the long run. And so that's been really helpful for the team, really helpful for me, and just so thankful for that perspective. And, I want to be clear, it's Paul. We also had some great conversations with Mike Trigg. And so I just want to call him out as well, and really thankful for their input and support.
And I know you have like 5 pillars or main values that you want to try to instill into your team. We don't have time to go through all of them in depth, but maybe you can mention them and then talk about which one you think is the hardest to get right.
That's easy. So, our 5 values, the ones we talked about, we've got build trust, which I think is very kind of self-explanatory. We want to do what we say. We want to say what we do. We want to pursue joy, which, means we want to do something that's more than just a job, but we spend so much time here. We want to be happy as well. We want to act courageously, both in executing our investment process, but also the way that we live our lives kind of in general. We want to be, we say great isn't good enough. So it's this idea of continuous improvement, which I think most of your listeners and anyone in this field, they're probably very big into continuous improvement. How do we get better tomorrow than we are today? And then finally, it's live generously. So how do we give back? And, one of the things our firm does, we say that 10% of our profits are going to be contributed to charity. And so that was kind of a big lift with our initial investors on the LLC side, but they finally agreed. And so we're going to give 10% of our profits kind of forever to charity, which is huge. And then we really try to give back as individuals, et cetera. But the hardest thing for us really is the pursue joy one, which you think wouldn't be that tough, but you really get these radical extremes amongst high performers. You've got some people who in college, let's say, just to describe it as a college student, you've got those people that, they're really into Greek life. And so while they were very intelligent, maybe their grades weren't quite what they could have been because they loved living life to the full. And so you've got some people like that in the work world who are like, I'm going to do a great job, but I also want to just be really, excited and do all the fun stuff. And they want to, pursue joy all the time. And then you've got those other people who, they were already making a 4.0, but they still want to go to the library and study for another 5 hours. And they don't ever want to do anything fun because they're so worried about always being perfect at all of it. And so in firms like ours, you get both extremes. And how do you manage those two extremes to say, hey, listen, as a culture, we want to pursue joy. And while we're going to work incredibly hard, we're going to be very good at what we do. We also want to make sure that we're balanced. This is a marathon. Again, 20, 30 years, not one, not two. And if we're burning ourselves out, working 80 to 100 hours focused with no joy and no release, that's a problem. And so it's how do we build a great culture? Well, we have fun together. How do we, make it through the hard times? Well, we've built trust via doing things in common that's more than just investing and more than just executing. And so really trying to get that balance right. That's been a challenge. And I'm not going to say we've arrived, but we're on the journey and hopefully we have something very valuable in a few years we can share with others.
Well, I'm not going to ask you about what you expect the firm to look like in 20 years, because that seems like outside of the, any kind of clear vision in terms of predictability. But I do care, and I'm always very interested in what success would look like and does look like for people. So if we're having this conversation in 7 years, what would success look like to you?
Well, I think the two easy ones to cross off are, one, we're still here having this conversation in 7 years. I think investment firms, the failure rate's pretty high. We think we have something that's different. The world does not need another asset manager. There's too many of them. There's more asset managers than there are stocks. So we're trying to add something of value above and beyond that. And we think we're doing that from the AI side. We think we're doing that from our values. We think we're doing that from how we recruit people and ultimately want to do something with them. So one, we're here. Two, we've really amplified the impact of our client partners. So I think as an investment management firm, you're judged on your investment performance. And on a net basis after fees, we're hopeful that we've created more value than the index. And if we haven't, 7 years from now, then we probably shouldn't exist. We should probably go do something else with our lives because we're not creating value. And then finally, and I think most importantly for us, the way I would define success is, as I've mentioned, we want to bring great people in, world-class, train them up, apprentice them. And then ultimately, if they have a vision to go do something, we want to get behind them and help them do that. And so what that would probably look like for us is having our first breakaway or our first spin out or our first tiger cub or however you want to call it. 7 years may be a little tight. I'm not sure we're going to be able to do it in that period of time. But if we have someone truly great, world-class come in and they're ready and we've been successful enough, I'd love to at least say we're in the process of contemplating what that might look like. And again, we think that's the way we're going to get the best and the brightest for the longest, is if we take someone, they're amazing, and we spin them out and they have success. I think anyone else in the industry who they're really great, they're going to look at us as an ideal landing place, somewhere they want to be, because that's the journey they want to take. And we're acknowledging that that's reality and that we want to support that, as opposed to say, hey, no, leaving is wrong and leaving is something negative.
So we want to close, because we've talked about a lot of things. I want to close with a couple questions about the investment opportunity that you guys are pursuing. And so we have a list of 100 best stocks and 100 best companies in the world that you follow. Maybe given your history at Vulcan and what you've seen at the first few years at Saguaro, what is the reason why one of these incredible companies would trade, kind of at the lower end or below the lower end of your sense of intrinsic value? What has to happen for something to be actionable for you? And what are the, kind of the external causes that get you there?
I mean, it's so idiosyncratic for each business. So for something to get to the low end of the valuation range, one, it could be the market in general. And I would make the argument that as passive becomes a larger and larger part of kind of the total allocations out there, you're going to see more volatility. And I think that's been exhibited. But the truth is, like, you don't have the counterparties out there. If Vanguard or BlackRock or somebody else gets major redemptions, there is no counterparty that can take, even 50 basis points of Vanguard redeeming in their largest S&P 500 type funds. And that would be, I think we're setting ourselves up next time there's kind of a major drawdown. I think it's going to be worse than anybody's anticipating in the short run, just because the liquidity isn't there. You do not have a counterparty to be able to take that level of AUM. So that could happen. I'm sorry, that's probably not what you're asking about, but it could happen. Mm-hmm. I think the other reasons are totally idiosyncratic. So the reasons why Meta got discounted last year are totally different from the reasons why we think Dollar General is discounted right now, right? Like, Meta last year, people are like, okay, advertisers are fleeing. Zuckerberg is spending too much money on the metaverse and not focused on the core business, and the regulatory risk is so high. And we looked at it, we're like, well, the users are using Facebook more than ever, and they're spending more time. There's more eyeballs, and we think the advertising thing was just kind of overblown in COVID, and now it's kind of settling back in the normal curve. And so we bought it, and lo and behold, it went crazy, which was great. Dollar General today, everyone's terrified of Temu, and they've had some bad press. I think they were on John Oliver tonight, like 2 weeks ago. And then, it's just their target market has really been squeezed as the cost of energy and the cost of housing has gone up. Maybe that's going to come back the other way. That would be great. But it's very idiosyncratic at different times. And, you never know why any one particular company is going to get discounted. We can't predict it. That's why we want to have a list of 100 so that there are opportunities. And again, you've got to look at it, because one of them, the stock price may go way down, and there may be a good reason for it. And so it's distinguishing between, this is something that we truly believe is temporary, it's cyclical, it's not a secular change where it's going to be permanent and there's destruction of value. And I think that's the hard part, where hopefully we get it right more often than we get it wrong. But yeah, I could go through every single one of our companies and talk about why we thought it was discounted when we bought it. But I can't give you like a general, these are the reasons in general, because it's very specific to each company.
And we'll close this podcast with the questions we're asking all of our manager guests. What do you think is the most underappreciated aspect of the investment opportunity set you're pursuing at Saguaro?
I think this is such a tough question. So I think, we're really investing in three things. We're investing in technology, which again, we don't believe people understand fully kind of the exponential curve there. We're really trying to invest in people in a different way by making ourselves conform to reality of great people want to go on and do great things versus we're just going to build our firm and they can be part of the journey if they want to. And then third, obviously, is on the investment side, which is, again, for whatever reason, it just doesn't seem to matter. But I don't think people understand long-term compounders, which is the whole point, I think, of your show. But it's, if you find a truly great business and you get it at a wonderful price, you can benefit from that idea for 10, 20, 30 years. So doing the work to find one of these, the long-term benefit that it can provide to your portfolio, to your life, I don't think is fully understood. I started as a special situations guy. And the problem that I realized was that I had these great ideas, they would play out, but then I had to go find another one. And it's like so much work, so much effort. And I get maybe, if I got 100% gain, that's like a huge cheering thing. It's awesome. But it's then you got to rinse and repeat. And that's a really hard thing to do. Whereas if you can slowly but surely over time build these, great lists of compounders, that's what Buffett has done. And, Charlie Munger, who we need to talk about because he just passed on. His big contribution is like, look, if you examine the Buffett track record or the Berkshire Hathaway track record, most of it was made up on a few great decisions that were made one time. And those things have just compounded over time. And frankly, just look at the most recent one Buffett did with Apple, where he's generated more actual dollar figure return for all of his shareholders from that one decision than everything he's done previously, which again, power of compounding, all the capital he has, et cetera. But, he's going to benefit. He's going to hold Apple probably for next 20, 30 years. And he should benefit for a very long period of time, just like he has with Coca-Cola, just like he has with American Express, just like he has with so many different companies. And so, we think there's a lot of power in it. It's underappreciated. If you're looking for a place to allocate right now, I would say, well, you got to ask the question about consumer discretionary and housing and how long people are going to go without moving. And is it something where, if interest rates keep going up or they stay where they are people just going to stay in their homes forever? Or is there a certain period where that eventually rolls off? So that's probably a longer term play than most people are comfortable with, but I'll just put that out there. I think there's some real opportunities in that space.
Well, this is incredible. Thank you, Jim, for talking about giving us a masterclass on how to think about AI, how it's actually used within your process, and then, layering in the depth of research you do on your own companies. I mean, it's just the quantitative plus the qualitative plus the technology. It's a really interesting mix. So I'm excited to see where Saguaro is in 7 years, and we'll be following your journey. Thanks for being on Compounders.
Ben, thank you so much for the time. And again, always happy to discuss with people out there, either on the allocator side, other investment managers. We very much believe in partnerships, conversations. We believe relationships can compound as well. So we're always looking to build them. Never know where they can go, but we think together humanity can do better things than they can on their own. So looking to build for the future.
Amen to that. Thank you.
Jim mentioned a number of securities on this podcast. The only company I own is Berkshire Hathaway.